वेलकम टू वी लर्न में आपका स्वागत है। सब्जेक्ट कॉर्पोरेट फाइनेंस, सेशन नंबर 11। टॉपिक कवर्ड इन दिस सेशन: मोदी गिलानी मिलर अप्रोच, व्हाट अबाउट रिस्की डेट्स, टैक्सेस, another important factor, after tax cash flow analysis, bankruptcy cost. Now, Modi Gilani Miller. The operating cash flow is divided into two components. Number one, cash flow to debt holders. Number two, cash flow to equity holders. Fundamental questions: does it matter how the split is made? कि इनको split कैसे किया जाए? If it does, we can create value also through financing choices, not only through investment choices. Modi Gilani Miller proved that capital structure choices are irrelevant. The split does not matter. This proof rests on the absence of transaction cost of any kind, taxes, trading cost, and bankruptcy cost. The proof of the theorem uses a no arbitrage argument. Financial market do not admit free lunch or free lunches or trading strategies giving you a positive cash flow with no prior investment. Consider two versions of the same firm. One version is U for unlevered firms with no debts, and the other version L for levered firm with debt and equity. So the firm have otherwise the same operating cash flows X. The unlevered firm has value VU and the levered firm value VL. The fundamental question is whether VU and VL differ. The cash flows of the firm U's equity holders is simply X. The cash flow of the firm L debt holders is 1 plus R into D to the firm's debt holders, and X minus 1 plus R into D to the firm's equity holders in total in cash flow of X also. The value of L is the combined value of the debt and the equity. Suppose VL is smaller than VU, then an investor can buy a 10% holding of L debts and 10% holding of L's equity, which entitles the investors to a 10% shares in the total cash flow X. He would then go to the market and sell 10% of the cash flows X, which is valued at 10% of the value of U. This leaves him with zero future liabilities. His trading gains are 10% of the difference between VU and VL, which we have assumed is positive. This cannot be possible in an arbitrage free market, so we can conclude that VL must be equal to or greater than VU. Now suppose VU is smaller than VL. Any investor buys 10% of the cash flow X and sells 10% of a claim that promises the cash flow 1 plus R into D. The net cash flow is 10% of a claim that pays X minus 1 plus R multiply D at maturity, which is priced at 10% of the equity in L. The net future liability is 0 and the trading gains equal 10% of the difference between VL and VU, which we have assumed positive. Again, this is not consistent with arbitrage free markets. In conclusion, it must be the case that VU equal to VL and that capital structure is irrelevant. What about risky debt? When the corporate debt contract is risky, it may be difficult to find a synthetic corporate debt contract if a real one does not exist. We must assume, therefore, that the markets are sufficiently complete in order to conclude that financing does not matter. Complete market, a market where the dimensionality of the assets structure equals the dimensionality of the uncertainty structure. If there are two states of nature, that is good and bad, then it suffices with two distinct assets to make the market complete. Bankruptcy cost. The Modigliani-Miller theorem also assumes that there are no dead weight costs of bankruptcy. The debt holders may not get all their money back if the firm defaults. But this is not in itself enough to jeopardize the theorem. There must also be dead weight cost or a liquidation cost, that is, the value of the assets in default is less than the value of the assets as a going concern. Tax is another important factor. The tax system is generally fairly complex with a different tax rate for different individuals and institutions. And for different type of income, therefore, it may be scope for tax arbitrage profits in financing. After tax flow analysis, a constant after tax discount rate are tax rate for personal income from debt TD, tax rate for personal income from equity TE, corporate tax rate TC, earning before tax and interest payment X, earning before tax X minus KD, and K coupon rate and D nominal amount borrowed. After tax personal income from debt, KD multiply 1 minus TD. After tax earning, X minus KD multiply 1 minus TC. And after tax personal income from equity equal to X minus KD multiply 1 minus TC multiply 1 minus TE. Algebra. After cash flow from investor prospectus, C equal to X minus KD 1 minus TC 1 minus TE plus KD 1 minus TD, which is equal to X 1 minus TC 1 minus TE plus KD 1 minus TD multiply 1 minus TC 1 minus TE divided by 1 minus TD. Discounted after tax cash flow, DC equal to X into 1 minus TC multiply 1 minus TE upon 1 plus R plus KD 1 minus TD upon 1 plus R multiply 1 minus TC 1 minus TE upon 1 minus TD. This is equal to value unlevered firm plus discounted tax benefits. Equilibrium. If there is positive discounted tax benefits, firm choose to borrow more and investor with higher personal tax rate on debt income is encouraged to enter the market. This implies a reduction of tax benefits of the borrowing. Reverse effect is there is a negative discounted tax benefit of borrowing. In equilibrium, we expect the tax benefit from borrowing to be equal to 0. This is the so-called Miller's equilibrium described in Appendix 14A in textbook. Preferred stock. Preferred stock means dividends on preferred stock are not tax deductible at the corporate level as are interest payment on debt. This implies that corporate junior debt may be tax efficient relative to preferred stock. However, the US tax code allows a 70% tax exclusion for preferred dividends paid to corporate holders. So the yield on preferred stock is often lower before tax than on junior debt, even though the debt has seniority over the preferred stock. Investors' conflicts. Tax exempt equity holders prefer in general to reduce the borrowing of the firm so as to transfer income from debt repayments to dividend payments. High tax brackets investors prefer the opposite. Often tax exempt municipal bonds or similar investment offer yield that are greater than the after tax yield on corporate bonds for high tax brackets investors. Thus, the firm can give these investors an advantages by increasing the firm's borrowing, as this frees capital that the investors can use to invest in tax exempt municipal bonds. Inflation. We expect to see a one-to-one relationship between inflation and nominal interest rates. If inflation increases by 1 percentage point, then so do nominal interest rates. Higher inflation therefore leads to higher nominal borrowing costs that yield in turn greater tax deduction. Therefore, the tax effect has greater weight in periods of high inflation. Empirical evidence. Do firms with greater taxable earnings borrow more? No, but this may be because firms in general rarely issue equity firms that perform poorly, therefore tend to accumulate debt to meet their investment. Tax code changes that affect the relative tax benefits of borrowing should have an impact on corporate financing. Yes, US tax reform of 1986, which reduced the tax benefit of the other things than debt such as depreciation rules and investment tax credits, gave rise to an increase in borrowing among firms most affected. The firm less affected did not increase their borrowing to the same extent. Taxes matter but do not explain everything. Exercise. A firm has assets valued at 100 and debt valued at 50. It plans to restructure its liability side by increasing its borrowing to 70 and paying a dividend of 20 to its shareholders. The debt has 0 beta before and 0.001 beta after the recapitalization. The beta of the equity is 2 before the recapitalization. What are the value of the equity before and after the recapitalization? Number 2, what is the beta of assets of the firm? Number 3, what is the beta of the equity after recapitalization? Number 4, the recapitalization has increased the beta of the debt and therefore the cost of debt capital. Has it also increased the beta of the equity? Does this mean that the total cost of financing has increased? Explain. Taxes and dividend. In frictionless market, dividend don't matter. Why do firm nonetheless pay dividends? Taxes and dividends, stock returns and dividend yield. What is the connection? Investment distortions caused by taxes and dividends. Cash flow to shareholders. Shareholders earn money through holding equity that earn a cash flow such as dividend and capital gains which can be realized through selling stock. The cash distribution to shareholders is normally discretional. The company can decide how much cash flow to give their shareholders. Cash distribution comes in two forms: dividend payments and share purchase schemes. Dividend payments do not affect the number of shares but will reduce the value of each share. Share repurchases do normally not affect the value of each share but will reduce the number of shares outstanding. How much of earning is cash flow to shareholders? Dividend payout ratio, the ratio of dividend to earning. In the US, this ratio has declined from about 22% in 1982 about 14% in 1998. Over the same period, the ratio of shares repurchases to earnings increased from 3% to about 14%. The total ratio of cash flows to earning has been relatively stable at about 25% of earning. Dividend yield. Dividend yield is the ratio of dividends per share over price per share. Typical pattern is that high-tech growth firms have low dividend yield and dividend payout ratio. Microsoft paid its very first dividend this year. Stable old economy companies such as mining, oil, and manufacturing pays about half their earning as dividend. What is the optimum dividend payout ratio? Assumption: frictionless economy, no transaction cost, taxes or other frictions, investment policy unaffected by dividend payments. Modi-Gilani Miller dividend relevance theorem. The choice between paying dividends and repurchasing shares is a matter of indifference to shareholders. Consider two identical equity finance firms. The only difference is dividend policy. Firm 1 pays 10 as dividend and firm 2 repurchases stock worth 10. After the end of the year, the firm are worth X. In the beginning, each firm has 1M shares outstanding. Each share eventually sells for X dividend by the number of shares. Firm 2 buys back 10 million worth of stock. If share price is P and the firm 2 buys back N shares, we know that P and 10 millions, we also know that P equal to X upon 1 millions minus N. Suppose X equal to 150 millions. Solving both equation gives us N equal to 10M multiply 1M divided by X plus 10M. So we get N equal to 62,500 and P equal to 150 millions upon 1 million minus 62,500, which is equal to 160. Firm 1 stock price is P 150M upon 1M, which is equal to 150. But each stock gives a dividend worth 10M upon 1M equal to 10. So the total value of each stock is 150 plus 10, which is equal to 160. Since shareholders get the same cash flow, eventually the shares must sell at the same price initially. That is, dividend policy does not matter. And do it yourself. What is theories? What is about risky date? And that's it from session number 10. Session number 11. Thank you.